Perfect. Yes. Next slide. Cool. Okay, so hi everyone. My name is Emily. I am representing Singapore Women's Network, which is a community aimed to bring professional women in Singapore together. Next slide. Yeah, so basically what we are is just a community for women to gather and learn from each other. However, if you're not based in Singapore, feel free to come to any of our digital events. We do have some online and in person. Next slide. Yes, so some context about what SWN is. We are a community of roughly 1,500 members, not only in Singapore, but also around Asia. So we do have a lot of events in person and online. And when COVID wasn't around, we had more meetups in person, like drinks, dinners, partner conferences, and workshops. But again, a lot of them have been gone online. So if you aren't in Singapore, you can still join us. And to just let you know, we don't have any membership fee or anything like that. So it is free for everyone to join. So if you want to follow along with SWN, you just subscribe to our newsletter. And next slide. And then basically, if you want to find out more, we have a QR code and we have all these social pages you can follow along. And if you have any questions, feel free to just ping in the chat or leave a message there. So yeah, that's just a little bit about SWN. And I just want to introduce Amanda as well, who is our speaker for today's webinar. Hey, Amanda, thanks for being here.
Thank you for inviting us to do this webinar today.
Yeah. So Amanda leads the StashAway client experience team, and she also heads the public relations regionally, and she's also a wealth advisor. So today she's going to give us a workshop and basically embark all her wisdom upon us. So I will let Amanda go ahead and take it away.
Right. So first of all, thank you so much, Emily, and to the Singapore Women's Network. Thank you so much for inviting us on. This is definitely a topic that I am very much passionate about. So before we jump into today's topic, I'm just going to quickly introduce myself a little bit and maybe my background and what I do at StashAway. So as Emily briefly mentioned, I do lead the client experience team. So that's essentially the team that speaks to our entire client base. So if you have a question about the app, the product, how markets are doing, about the portfolios, that is handled by my team across 5 countries. And I'm also a wealth advisor to our high net worth and ultra high net worth clients, which is really where my background is from. Before joining StashAway, I actually worked at a multi-family office / wealth management firm where I was advising the investment portfolios of ultra high net worth clients. And before that, I was with Citi, where I was working with portfolio managers, fund managers, for their and providing them with securities and fund services. So today's topic is actually one of our ad hoc topics, our electives, and it falls under our umbrella of StashAway Academy. It's essentially one of our Investing for Women curriculum. So as you can see there, it's at the bottom, it's actually an elective for us. It's an kind of a adaptation of financial planning basics, but we dive a little bit deeper into the relevance for women and obviously very women-specific examples. We talk a little bit about kind of the fact that a lot of women in Asia and pretty much around the world as well are not very much involved in the financial decision making of their household. So, and we explain a little bit of why it is actually important for them to be a little bit more involved. So this falls kind of as part of our beginner courses. It sets a really good foundation. If you're interested to attend any of our other courses, we do weekly webinars, or you can watch it anytime on our mobile app. It's free to kind of use. It's free to download. You can watch it at bite-sized pieces anytime you want. So jumping right into today's topic, which is financial planning for women. Before we kind of do that, let's just kind of step back a little bit to define really what is financial planning and taking charge of your finances, right? So financial planning is actually the process of meeting your different life goals. So that can be retirement. Maybe you want to save enough to buy a house in a few years, or maybe you want to buy a car or save up for a wedding. So these are your different life goals. And it's a process of actually thinking about these different life goals and setting up a very systematic and disciplined arrangement, or essentially a disciplined approach at saving towards meeting these different life goals of yours. right? So that is what essentially financial planning is. And let's look a little bit at kind of are women actually involved in financial planning decisions in their households, right? So a lot of times, obviously, this might not be relevant for you in the sense that, maybe you are very much in charge of your finances. But as you can see here, this is actually, a problem pretty much around the world, right? In Singapore, we have the majority of women actually letting their spouse take the lead in financial decision making. This is very much the same in Hong Kong as well. And even when you are looking at kind of in Western Europe or in the US, these numbers are very similar, where, at the end of the day, the majority of women still leave daily financial decision making to their spouse, right? And these are some of the very common examples of why people actually decide to, or why women decide to step aside when it comes to long-term investing decisions. The first of which is that, for example, they might think that their spouse might know more about the topic than they do. Some women even say that, perhaps we take a divide and conquer approach. My spouse takes charge of the finances, the investing for the family, while I maybe take charge of the household, the kids. And some people give examples of, maybe their spouse is the primary breadwinner in the family. So this might, be some of the examples that you hear from your friends, from your sisters or anyone that you might know. And even though it might not be applicable to you, the reason that this topic is super important to talk about is because, as you can see, the majority of women in Singapore still are not very much involved in financial planning or investing decisions. So it's very important to create awareness, to make sure that they are very much involved. Because one thing that we do see a lot of times is that you might have someone, and maybe I'll give a personal example, which is, for the longest time, I've been trying to tell my mom to get way more involved in the financial planning decisions, just because, to be honest, if something happens to my dad tomorrow, she will have kind of no idea where the family's finances are kept, who to contact, which relationship manager in the bank to contact, and thereafter how to kind of manage the funds once she gets access to them, right? So this is, definitely a problem that many people face, and I think it's something that all of us, even if we are very much in charge, to actually, raise awareness, share it with our friends, families, moms, sisters, as it's a very, very important topic. So 64% of women in Singapore actually believe that they will outlive their spouse, right? So first of all, on average, women do tend to live way longer than men. And so, but when it comes to long-term financial decisions, 72% of women actually defer their decisions to their partners. So as you can see here, there is that risk that, the spouse who is very much involved in the investing decisions, who is very much involved with the financial planning for the household, they might pass away, and the responsibility would then fall to the woman, who may obviously not have any experience or any knowledge in doing so. Right, so this is a very important topic to kind of think for yourself and to obviously try and take charge of for yourself. So this is the actual stat for Singapore that I mentioned earlier, broken down a little bit. So as I mentioned, majority of women are not very much involved in financial decision making, and only 20% of women actually take the lead themselves. And on average, about 8% of them share that responsibility with their spouse. So this is the stats for Singapore. So why do women actually, kind of leave or defer financial planning decisions to men, or essentially to their spouse? Sorry, this is actually a repeat of the previous slide. So I'm just going to skip through that. So can women afford to take a back seat, right? So we know that, first of all, we tend to live longer than men on average, and also that we tend to leave or defer the financial decision making to men. Well, men on average have life expectancy of 81 years old, while women tend to actually have on average a life expectancy of 86 years old, right? So we tend to, on average, live 5 years longer. And so there is obviously the risk I mentioned earlier that, your spouse might pass away, and you would then have the responsibility of managing the finances. So these are some of the worries that women actually have when it comes to finances, right? 71% of them are worried that they might run out of money in their retirement years. 61% are worried that they have to actually work longer than they planned, just because they obviously did not think about their retirement early enough. They did not think about how much money they actually need to save. So this is obviously a big problem. And 58% of them are worried that they might become ill and become unable to work. 46% of them are worried that eventually at some point in time they will need to support family members. So with all of that worries, obviously, we also have very unique strengths when it comes to actually taking charge of finances and also in investing, right? So there are a lot of kind of strengths that we have that include us being, in general, we value kind of our independence. We love, our work and our family. And also we try as much as possible to meet the demands of having, caring for the family, working and maybe caring for the family at the same time, as well as also keeping in mind that we have, on average, a longer life expectancy. So with all of that, now that we kind of know that it is kind of a problem that we need to be a little bit more involved in, I'm going to kind of run through a few steps of how you can apply it for yourself, and how you can think about how much money you would need to save, how much money you would need to invest to meet your different financial goals. So this is a very commonly used financial planning process. It is something that I use with my clients as well. Typically, we start with the first step, which is to determine your current financial situation. So you obviously need to start with a base of understanding what your personal balance sheet is, how many assets you have, how many expenses you have. So how can you go about doing that? The first thing you can do is actually to maybe kind of, and it's probably a more tedious approach, but if you want to be very, very accurate about it, you can actually, open an Excel sheet and start manually accounting every expense that you have. You can start manually accounting how much assets you have. So whether you own a property, you can add it into your asset under your balance sheet. If you have a loan, that would go to your personal liabilities. And then essentially what you can try and calculate is where you stand right now, what your financial health is, and what your net worth is. So this is a very detailed approach to do it via an Excel and do it very manually. The next thing is to maybe work with an app. So there are a lot of apps available right now where you can easily kind of calculate your monthly expenses. You can very easily calculate kind of your net worth by entering the different assets that you have, the different liabilities that you have. So that might be a very, very easy approach to use. Or finally, you can quite simply also download the files from your bank, which will give you an idea of your expenses if you use a credit card a lot. And it can also give you a summary of your assets, so your cash in the bank, your investments at the bank, as well as any loans that you may have taken with a bank, right? So these are the three different approaches you can go about doing, or kind of go about finding out what your current financial health is, right? And another kind of common myth when it comes to people looking at their expenses or looking at their financial health is it's a myth, because people think that you can only spend on what you need and not on what you want, right? So this is a myth because it makes thinking, or it makes financial planning very, very tedious for yourself. It makes it something that you want to try and avoid, right? So financial planning should not be, making sure that you're not enjoying yourself. It should not be about making sure that you're not spending on that expensive pair of shoes that you want, right? It is about budgeting. So if you have proper budgeting, making sure that every month you set aside what is called your fund money, or let's say you set aside a certain level of funds that you can use to enjoy, right? And making sure that every month that is what you set aside to do to enjoy yourself, and keeping to that, and obviously setting aside enough to meet your savings and investments, then that is the ultimate goal, right? Making sure that you're not depriving yourself of any kind of enjoyment in life. And a very easy approach to think about this, if you're thinking about how much should I save, how much should I invest, and how much can I spend, you can quite easily follow the 50-30-20 rule, which is to spend essentially 50% of your funds on things on expenses. So essentially things that you need to spend on. So it might be your rent, it might be your mortgage payments, might be your utility bills. 50% of your monthly income should be set aside, or can be set aside to meet those necessary expenses. 30% of that should be set aside for savings. So a very good way I kind of go about doing this that helps me do it automatically is the minute I get my salary every single month, I automatically transfer 30% of that into a separate account within the same bank. And it's, clearly, obviously in my mind, I know that I can't touch that money anymore. And that really helps mentally to make sure that I try and follow a regular savings plan. And then the 20% rule is the 20% remaining amount of your income is the amount that you want to spend on things that you want, right? So also making sure that you have set aside enough funds for that is very, very important, so that you make this, obviously, this whole financial planning process very way more realistic for yourself. The second thing to obviously, after you've kind of determined your current financial situation, how much you're going to spend on expenses, how much you're going to save, is to develop your financial goals, right? So you might have many, many different goals. One goal might be, let's say you are looking to do a master's degree, right? So on average, it actually costs 35,000 Sing dollars to do a master's degree at one of the top kind of local universities in Singapore, right? And that, that is the cost for 2 years. And if you're looking to do kind of an MBA in the US, that obviously that amount goes way higher. It can be up to 350K to pay for tuition and board for 4 years, right? So that might be kind of a plan that you have, and your goal would be to make sure that you have $35,000 at a certain point in time when you want to go and pursue your master's. So that's one financial goal that you might have. Another financial goal that you might have is to make sure that you have what is called an emergency fund in place. And an emergency fund is very, very important, because you want to make sure that if something happens, if something unexpected happens, and you never know if you lose your job, that you have a certain level of savings that will help tide you through for a certain period of time. So the typical recommended emergency funds is to have at least 6 months worth of expenses in this emergency fund. And you want to keep this emergency fund in what we call very liquid, in a very liquid form, meaning you want to keep it such that it's very easy for you to get access to it. You don't want to have these 6 months worth of expenses invested in properties, for example, where it is what we call very illiquid. If you need access to the cash all of a sudden, it will take you a very long time to potentially get access to it, because you have to list the house, do viewings, and then after that sell it. So that might take months. So you want to make sure that you keep it in very kind of liquid forms, maybe in a savings account, or, for example, a cash management portfolio or a money market fund, right? Where it's very easy for you to get access to. You can buy and sell it very easily if you need access to the funds in times of emergencies. And maybe perhaps another goal that you might want to have is to kind of save for your child's education. So this is actually something that for me, working with a lot of clients, it is a goal that they create on our platform. So I'm not sure if you guys are currently users of StashAway, but you can actually create different financial goals on our platform. And actually, one of the goals is to save for my child's education. So I have a lot of clients who are parents, and they're trying to save for their child's education. And working out how much you would need to achieve that is obviously part of reaching that goal, right? You need to first work out how much money your child would need, and then the second thing you would need to work out is how long it would be until your child would need access to that funds for university, right? So obviously, let's say your child is a years old and you expect for them to go to university at age 18. So that's a 17-year investment timeline that you can save and invest the funds to hopefully reach the goal to send your child to university 18 years from now. So that's how you can go about thinking about how to set a financial goal, right? So the first thing is how much you need. And the second thing is, when would you need it, right? And that would be kind of your investment timeline. So for retirement, for example, you want to work out how much money you would need at a point of retirement, maybe at age 65. And then your investment timeline would be from your age at this point in time to, how many years is it until you're actually going to retire. So that's your kind of investment timeline. And when you are thinking about your financial goals, these are the two main things to keep in mind. And one obviously important thing that might be relevant for some of us is that 22% of working age mothers actually stop work completely to look after their families, right? And obviously men, it is a much smaller percentage. So there is another added consideration where you might want to think about potentially even saving more, because you would then have to, depending on obviously how you work out that arrangement with your spouse, you might potentially want to think about saving more so that when you are stopping work completely, that you still have a good amount of savings to kind of tide you through the months or years that you would be out of work, right? And this is what I mentioned earlier, the retire, thinking about how much you would need to retire. And for those of you guys who are thinking of, let's say, retiring with a $6,000 monthly expense, and this is obviously, just an example. If you are looking to kind of gain access to maybe 3K a month instead, you can simply approximately divide that amount by 2, just to kind of get a good estimate, right? So you would need actually $1.8 million to have a $6,000 per month income once you retire for 25 years, right? And the reason that I'm saying 25 years here is assuming that you retire at age 65. If you remember one of the slides earlier, on average, women tend to live until age 86, right? So needing cash or savings for 25 years is a very kind of realistic thing that we need to think about. And a lot of times people forget that once you are obviously retired, you are no longer drawing a regular income and purely kind of living off your savings, right? So you have to think about making sure that you're saving enough to reach that retirement sum at age 65 to last you for a certain period of time. So it's never too early to obviously start saving for retirement. And the great thing about starting early is that you can start to benefit from the effects of compounding, right? So this is good for people who are still in their 20s. If you're thinking about how to start, I would say, honestly, just start, right? Do some research, figure out a platform you're comfortable using and start investing so that you can start benefiting from the effects of compounding for your investment portfolios. And about 73% of millennials are actually already contributing at least 3% of their monthly salary to retirement. This is obviously a very, very small sum, but it is something. And obviously the kind of closer you get to retirement, that percentage should increase. So women, the did you know was a fun fact that I mentioned earlier as well. The next thing after you've developed your different financial goals, be it, to save for your child's education or save for retirement, you want to then implement your financial action plan, right? So what is your financial action plan? There are quite a few steps to it. The first thing is to pick the goal that you want to prioritize, right? So you should always obviously try to prioritize to firstly pay off any debt that you have because it can work for or against you. And then the second thing is to then potentially think about setting up your emergency fund, and that should come before you investing. Emergency funds are very, very important. And then after that, you can think about how you want to allocate your savings to your different financial goals. So first of all, pick the goal that you want to try and achieve. After you've prioritized these different things, then you want to review your monthly savings budget, right? So think about how much you can set aside, how much you want for savings, how much you're going to set aside for expenses. And then once you have the amount that you're looking to save, you obviously want to look to put it towards your financial goals. The third thing is to then use your preferred savings platform, right? So you can use a player like StashAway. We're not really a savings platform, more like an investing platform. But a lot of people use us to kind of invest their savings, right? So that might be one option, or there might be other players that you might want to look at. So the main thing is to do your due diligence, and this is something that I emphasize a lot. Make sure that you understand how much fees you're paying, understand the kind of sophistication of the platform, understand who is behind the platform. These are important questions, and you want to make sure that you do your due diligence. If you're interested to learn more about kind of how to pick different investment platforms, you can attend our investing basics, and we touch on that quite a bit. And then the next thing is to just start your monthly budgeted amount, right? Whatever you've set your mind to kind of invest or to save, you want to make sure that you kind of stick to that. And a very easy way to think about how much you should save and invest, as I mentioned earlier, is to just automate that, right? Once your monthly income comes, automatically transfer that, if possible, to a separate account, so you know that you can't touch that other account. And then what we typically see a lot of clients doing is to set up a standing instruction. So you have maybe a standing instruction with your bank where you can invest on a monthly basis a portion of the savings that you've set aside. And finally, the main thing is to just start, right? You want to make sure that at the end of the day, as I mentioned earlier, just starting is the best thing you can do for yourself, right? Not just wait around and then wait for something to happen. I think a lot of times what I hear from a lot of women is that they just don't know where to start, right? So I would say the best thing is, for example, find a platform where there's no minimum investments, right? Maybe try a little bit, put in $10, put in $20, see how that works, and then when you get more confident, you can obviously put in more with time. And then the fourth thing is to identify alternate courses of action. So now that you have your plan A, which is how much you're going to set aside, how much you're going to invest, how much you're going to use on expenses, you have to obviously have what is called plan B, right? Which is, if something unexpected happens, making sure that you have certain things in place. The first thing is a will, right? So a lot of times people kind of, I think this is not something that is talked about enough. And people often hold off setting up a will until they are in their 50s, 60s, 70s, or later, which is obviously a huge problem, right? And we dive way more into this in our financial plan B. But there are a few things I'm going to say here. So if you do not have a will in place, what's going to happen is that the government, there is what is called an intestacy act. So your kind of assets, as well as anything else that you have, is going to be distributed according to this intestacy act. So you might find a situation where you might not very much like someone in your family. Maybe you don't want to leave too much to them, right? And if you don't have a will, you might find that a lot of your wishes, unfortunately, when you pass away, might not be fulfilled, right? And a lot of times, the will is also important if you have kids. Right, so let's say you are a single parent, for example, and you maybe have, and there are situations, and I heard of this, where a lot of times people might not want to kind of pass their kids on to maybe a sibling or maybe a parent, right? Maybe because they're alcoholic, or there's some issues with their parents or their siblings, and they don't want their kids to go through them if something happens to them. Then having a will in place is a very important way to make sure that your kids are kind of taken care of by who you want them to be taken care of, right? So that's the importance of a will. It's very easy to set up. Right now, there are a lot of kind of free services that can help you with this, but I do recommend using a good one, and you can actually find a very good will service for, I would say, $100, $200 online. So I would highly recommend that. And what I would say on top of a will is to also have what is called, I like to call it a black box, right? So essentially, you have a list where you put down every single bank account that you have. You write down every single investment account that you have. You write the account number, and then you also write the relationship manager and the contact number of the respective bank or investment platform. And you put that together with your will, and you let your spouse know, or you let your kids know if something happens to you, go to this black box, right? And what happens is that if something happens to you, they will understand. They will immediately be able to identify where all of the funds are at. They will be able to immediately contact the relevant relationship manager and kind of start the proceedings, of kind of getting the funds or getting hold of the funds, right? So this is a very easy way to try and make it as easy as possible for your dependents. The next thing is an advanced medical directive. Obviously, if you have certain wishes, let's say, for example, to not what we call do not resuscitate wish. So you do not want to be resuscitated, or for extreme measures to be used on you if something happens, then you would want to put an advanced medical directive in place so that wish can be followed. Another thing might be a lasting power of attorney. So if you need unfortunately a car accident, a lasting power of attorney grants someone, maybe your family member, authority to obviously make decisions on your behalf, and that is going to be very, very important. You want to make sure that you appoint someone that you trust, and a lasting power of attorney is very important to be able to do that. And then finally, life insurance, right? So if you have dependents and you maybe want to leave, you want to make sure that they're well taken care of should something happen to you, life insurance might be a good option. And a lot of times, I would say term insurance is a good way to go about doing that. So we don't dive too much into life insurance. Obviously, if you're interested, there are a lot of available players out there. But what I would say is to make sure that you also, once again, do your due diligence. Make sure that you are not kind of investing in high fee products. And in general, things that you might want to think about is to think about insurance and your investments separately. So I'm not going to dive too deep into that, but these are some of the things that you might want to take note of for your plan B, right? Your financial plan B, should something happen to you. And the last thing is to make sure that obviously your life circumstances might change. You might get married, you might have kids. Periodically, and I would really recommend to do it annually, review and revise your financial plan that you have set in place, right? Because circumstances might change. And a lot of times people are not aware that, you have to, for your CPF, for example, you have to actually nominate someone. And, let's say you nominate your wife. If you and your wife divorce, in this case, let's say you nominate your husband. If you and your husband divorce, they might still have access to your CPF funds should something happen to you, because the CPF nomination is not automatically kind of renowned if something happens to you, right? Even if you get divorced. So you want to make sure that you update your CPF nomination if you get divorced, for example. So these are some of the things that you might want to take note of, and reviewing your financial plan really helps with that, right? So these are some of the steps that can really help you in reviewing your financial plan. The first thing is to, as I mentioned, do it on an annual basis, and especially when life events happen, you want to make sure that you update your financial plan, plus your will or any other kind of, maybe your life insurance plan, or even kind of your LPOA, for example. So do that regularly. And make sure that you have the most updated data on it. And, this is not a topic that a lot of people like to do. This is not a topic that I like to do. And so typically when I'm doing my annual financial plan, what I do is I make sure I have a glass of wine with me. It makes it easier to get through. So, that's something that you might want to do, right? And so if you're doing that, maybe with your spouse, kind of make sure that you maybe do it over something that you enjoy, a nice meal, for example. Right. So every time you implement a step in your financial plan, you want to make sure that you celebrate that as well. Because, it is something to celebrate, right? You're following something that you have set aside for yourself, a very disciplined plan. And to make it easier to follow, just, make sure that you kind of pat yourself in the back every time you do that. And there will be times where maybe you have set aside a certain amount for your expenses, and you might go over that. Don't worry about that. Just make sure that, the next month you think about that more consciously and work towards making up for it slowly, right? You want to make sure that just because you exceed your expenses plan for a month, that you do not just give up on your entire financial plan. So this is what you can use on the app, right? So this is, as I mentioned earlier, if you're looking to think about your different financial goals, we actually have a retirement calculator on our platform. It is also free to use. We don't charge anything. And so you can just use it to calculate how much money you would need for retirement. And we ask you certain questions, including, how much monthly income you think you need during retirement, as well as your expected age of retirement, and then basically give you the sum that you need to save. So if you're not really sure how much you need to set aside for your retirement, this might be kind of an easy fix that you might want to explore. So what are some of the key takeaways from today? The first thing is to know yourself, right? Know your financial situation, calculate your net worth. And you can use the different methods I mentioned earlier, having an Excel sheet, using an app, or making sure that, or kind of doing a very kind of Excel deep dive into that, or you can actually also use our platform to help you do that as well. Calculate your net worth and create a budget, right? So set up a budget for yourself. Maybe you can follow the 50-30-20 rule, or you want to obviously adjust accordingly for your own needs. Just make sure that you obviously have a plan of what you want to set aside or spend every month. The next thing is to have financial goals. So identify firstly, what your goals are, whether it's to retire at a certain period of time, whether it's to save for your child's education, whether it's to kind of pay for your master's program or to buy a car, right? Identify what your goals are, calculate how much you need and when you need it. And then the next thing you want to do is to rank them, which is more important for you, right? So maybe sending your child to university is very important to you. So that's something that you might want to save and invest more for. So rank your different financial goals. And then, as I mentioned earlier, understand the cost of them. And also finally, think about coverage, right? So which is financial plan B. Be prepared for unexpected life events, have appropriate insurance coverage, and make sure that you keep your plan up to date. So do that annual review, or whenever you have an unexpected life event, update your financial plan as well. So these are, if you're interested on, this is kind of the follow-up to today's topic, investing basics, how you can invest, how to plan for retirement, as well as what I mentioned earlier, financial plan B, where we dive a little bit deeper into the alternate courses of action should something unexpected happen. So if you're interested, you can follow us on our website, or we're happy to do this again for you guys. So I'm just going to spend 2 or 3 minutes just to quickly talk about StashAway, and then I'm going to jump into Q&A. So for those of you guys who have any questions about today's topic, about anything that comes to mind, there is a Q&A box at the top of the screen. So just post your questions there, and I will get to it in a few minutes. Okay, so maybe can I get a quick show of hands? How many of you guys actually know about StashAway? Okay, great. Okay, some of you guys do, right? So for those of you guys that do not know who we are a digital wealth management platform we're headquartered in Singapore, but we now operate in 3 countries. So Singapore, Malaysia, and the UAE. We basically build investment portfolios for our clients based on their financial goals, their current financial situation, and their risk appetite. So we have many, many different risk levels to suit their different financial goals and their different investment timelines. We are regulated by the MAS. We have what is called the Capital Market Services License, which is one of the most stringent licenses to get. And one requirement of this license is what is called a custodial structure. So a lot of times I get this question. Obviously, it's a very valid question because people are worried and they're investing a lot of money with us. And the question is, what happens if StashAway goes bankrupt? Well, the answer is that nothing is going to happen to your funds and your portfolio because of this custodial structure. So when you invest with us, at no point in time are your funds commingled with ours. Your cash is actually kept at HSBC and your securities in Citibank. So if that should something happens to us tomorrow, you will still have a claim on your assets at these underlying custodian banks. We have decades of investment technology and management experience. I'm not going to dive too deep into that. If you're interested, you can go onto our website to have a look. And then finally, our fees are between 0.2 to 0.8% per annum. No minimum balance, no unlimited withdrawals, no lockups, no withdrawal fees or penalties. The only fee that we charge to you is that management fee that you see on the screen right now. Okay, so I'm just going to spend a few minutes now to quickly jump into Q&A.
Awesome. Thanks, Amanda. I can quickly route the questions over to you. So I think, so the first question that we had is regarding tracking expenses. So does StashAway also have a feature that allows you to track your own personal expenses, or is it more around your net worth?
It's more towards your net worth. It's more about financial planning. But if you're thinking, so right now, to be honest, I think tracking your expenses with an app, there's an app called Sidley. I'm not sure if you guys have heard of that. That app might help you track your expenses easily. In fact, I believe if you have a DBS bank account, you're actually able to automatically feed your expenses to the app. But yeah, another alternative way is obviously to track via an Excel sheet.
Gotcha. All right. Next question would be, under what circumstances would you recommend to engage a financial advisor?
So there are different kinds of financial advisors. So you have certain financial advisors that are a little bit more focused on insurance, and you have financial advisors that are a little bit more holistic. So it really depends what your needs are. And what I would say is to perhaps keep in mind, first of all, if you're looking to invest, you want to make sure that you are doing your due diligence and your financial advisor is actually well equipped to give you that investment advice. I think a lot of financial advisors out there are more towards the insurance front. So they might not be obviously investments might not be an expertise. So making sure you do your due diligence is very important. And when would I guess engaging a financial advisor be relevant? Let's say you have really no idea how to go about financial planning, and you obviously need help. Then maybe a financial planner, financial advisor might make sense. Do take note though that there are a lot of financial advisors that have kind of kickbacks or kind of agreements with insurance companies or the banks where they get a kickback from selling you a certain product. So make sure you ask those questions and see if your incentives are aligned with your financial advisor.
Gotcha. Yeah. And also, I think it's important to attend webinars and workshops like this and meet wealth advisors like you. Yeah.
Yeah.
Yeah. So it's good knowledge. And then we have one around financial advice, which is what's one financial advice you would give to someone who just started their career?
Yeah. So the funny thing is that I came from a very purely investment background. I studied finance in university. When I first came out, I started work at Citi. So I've been surrounded by investments my entire life, but I did not start investing until a few years ago, which is probably my biggest mistake. I was way too busy at work, and also working at a bank, you have restrictions on the trades that you can make. It's just way. I mean, for those of you guys that work with banks or work in a financial institution, every single trade you make, you actually have to declare. So that becomes very tedious, and so I did not invest. So the one advice I would give is to make sure that you start investing. The funny thing is that fun fact is that the largest industry represented in the StashAway's client base is actually people working in financial services, because you don't actually, when you engage, when you invest with us, you don't actually have to declare every single trade. So this is that one barrier that is removed for people working in financial services. But even if you don't use us, I would say make sure you just start investing, and so you can start compounding over time.
Yeah, no, I think that's good advice. I think the best time to start is always now, right? Yeah, and I've heard that a lot too from other people that I've met. They said that, yeah, one thing is very consistent, is like, oh, I wish I invested earlier, right? But that doesn't mean you can't start now. So yeah, I think that's really important. I have a question for you, which is regarding like any personal tips on how to save better or to be more strategic in saving more consistently. Like for me, I do automation. So for me, I'm like, if I don't see the money, I don't touch it, right? I'm like, I put it as far away as for me as possible. Like I route it to a different bank account overseas. Yeah, like that's what I do. So I'm like, I don't want to touch my money. But for you, yeah, like how do you save, or how do you like put yourself in the mindset that I cannot touch this money and I need to just save? Yeah.
I do the exact same thing. So I set aside automatically. I don't route it to a foreign bank account. I just route it to a separate account within the same bank, and I know consciously that I can't actually touch those funds. And I think that's the most important thing. And also being realistic with myself, right? I'm not, I wouldn't say kind of too strict in terms of what I can spend on. So it makes it easier for me to meet my different goals, other than just simply kind of restricting myself and being too strict, and then being unhappy all the time. So having, what I kind of set aside as like my have fun money, that really helps me.
Yeah, I think it's a lot about balance too. So I completely agree with you on that aspect. The other question I actually had too was regarding emergency funds. So especially with COVID happening and people, getting retrenched or losing their jobs, I think from what I've heard that some people say, oh, maybe your emergency fund should be around like 6 months of personal expenses. With COVID, do you think it should be higher, like to a year? Like, what are your thoughts on that?
Yeah, so everything really depends on a few factors. It depends on how secure you feel in your current role. If you do not, then obviously having more emergency funds would be definitely something very important. And also, kind of the older you get, it's way more important to maybe more than 6 months, right? The younger you are, I would say at least 6 to 9 months should be sufficient. But when you reach your 30s, 40s, you want to probably work that up to at least 12 months worth of expenses in your emergency fund. So those are some of the considerations you might want to think about.
Gotcha. Yeah. Another question we have from the audience is, what is a good savings to investment ratio I should be having?
Yeah, so as I mentioned earlier, the 50-30-20 rule is pretty good. So thinking about 50% of your income can be set aside for your needs, so your mandatory expenses. 30% of it should be set aside for your savings, and then 20% for kind of your wants, right? So if you want to go out for a nice dinner, buy a nice pair of shoes, that comes from 20% of your income. That's a kind of a rule of thumb. Obviously, you can adjust accordingly depending on your needs. Personally, I think I save on approximately 35% or 35 to 40% because I put about 20% into my StashAway portfolios actually.
Gotcha. Yeah. I think another question too that probably most people would want to know is like what books would you recommend, right? I think the most popular one is like Rich Dad, Poor Dad, right? Like how, like, certain books like that. But I think, in the modern day, like what are some good book recommendations to even start looking into whether it's like saving or investing? Yeah.
So there is one that comes to mind. And I remember it just being a great book. I just can't remember the title right now. It's just, I'm blanking.
Okay.
But maybe what I'm going to do is I'll send it through to you after, and then maybe you can inform everyone that attended today's webinar. But yeah, I mean, there are definitely some books out there. Rich Dad Poor Dad is a very popular one. But I would say also maybe consider. So one thing about books is that in general, they might give you what I mentioned earlier, that rule, right? 50-30-20 rule, something good that you might want to follow. But I would say there are a lot of kind of free educational webinars out there. And some of these might give you more practical advice. Like for example, right now, we're doing a Q&A and we're able to actually talk about, questions that might be very relevant to your situation. So that might be the added benefit that comes with some of these educational webinars. Not all of them are good, but yeah, find a good one and then try to be a little bit involved in that. We do actually Investing for Women regularly, so if you're interested, you can always come onto our website for that as well. And then one thing I would actually recommend, just because, okay, maybe I'm a little bit biased, but I do think it's very good. On our website, we write a lot of personal finance articles. How much should you set aside for your emergency fund? How to meet your different financial goals. What are some 5 beginner steps to investing? We don't talk about StashAway in those articles at all. It's just actionable points that you can actually think about.
That's great. And you guys also have like a YouTube channel as well, right? Like with like short video formats. Yeah.
Yes. So I think I do recommend those as well. It gives you very bite-sized tips. And if you have any questions, just write into us via email, WhatsApp. It doesn't even have to be about StashAway. We're happy to help answer any questions that you may have.
Gotcha. Sorry, looking at the slide too. So I think the question that I see pop up right now too is like, is a robo advisor right for me? So I think for like first time investors, would you recommend a robo advisor or to have someone just dabble into investing themselves?
Yeah. So I think the thing with doing it yourself, there are a few considerations, right? First of all, if you have a day job, do you have the time to do that? The second thing is that the costs might be quite exorbitant. So when you trade yourself, you might have to pay a platform fee. You have to pay a transaction fee every time you buy and sell. And obviously, because this is completely new to you, you have to think about what the investment portfolios that you're doing. A robo advisor or a digital wealth manager like us might be an option you can explore. There are honestly many players out there right now, so I would highly encourage you to do your due diligence, grill us, write into us, make sure you ask all of the questions and kind of grill us on that, and make sure you grill every other player so that you understand the fees that you're paying, you understand the portfolios that you're investing into. The great thing I think for us is that we're trying to make it as easy as possible to start, right? So you can invest $10,000, sorry, not $10,000, $20 with us, and you can get a fully diversified portfolio. And I would recommend maybe starting with a small amount like that. And then when you see how it looks like on the app, you can see what kind of asset classes we're buying for you and what price, everything on the app. When you get a little bit more confident, then you can invest more. So that's, I guess, the easy way, because when you trade yourself, usually the minimum requirements are much higher. So for us, we have what is called fractional shares. So we actually pull the funds together and invest. So even with $20, you can get a fully diversified portfolio, and you wouldn't be able to do that yourself.
Yeah, no, I think that's great actually. I think to be able to invest with, even like $20, that's awesome because I know a lot of other platforms require like a minimum and that's like a couple hundred. And I think that also deters people from going into these like investment platforms.
Yeah.
So sorry, there was one question regarding like the name of the app again, the one that you were talking about regarding to track expenses. How do you,
Sidley.
how do
I'm
you,
just gonna,
Easy?
yes,
Okay.
yes, that's it.
Okay, gotcha. Yeah, awesome. Are there any other questions out there? I think this is a really good time to ask Amanda because we have her here in an intimate webinar. I feel like I've gotten all my questions answered as well. But if no one has any other questions left, I think what we can do too is like actually, Amanda, if anyone wants to reach you, how should they reach you? Or should they reach out to StashAway directly?
Yeah, they can reach out to StashAway. You can just put my name on there, and then my team will basically kind of send it to me, and I'm happy to reply and help out with any questions that you guys have.
Awesome. Cool. Okay. Well, I don't see any questions coming in anymore. Oh, actually, there's a lot of Q&A ones that I just saw pop up. So there's 3 more questions if you want to just go over them because I think we have 7 minutes left. Okay. Let's see. So would general investing 36% mean the same investment horizon as investing with 6.5% risk?
Yeah, so this is definitely a StashAway user, yeah. So this is about our portfolios. So that's how we classify our portfolios. The 36% StashAway risk index is the highest risk one, and the 6.5 is the lowest risk one. So this is a great question, and it's a great question, especially when it comes to thinking about your investment horizon. So on average, typically, if you have a longer investment horizon or longer investment timeline, you can afford to take on a little bit more risk than a shorter term investment horizon. So the reason for that is that the longer your investment timeline, you can ride out all of the short-term volatility. You can ride out the recessions that might happen over the next 1 or 2 years to hopefully get the higher expected return that comes with some of the kind of more volatile portfolios. However, if you are looking to maybe save for a car in 2 years or save for a house in 3 years, right? You want to make sure that you are invested in a more kind of conservative portfolio, just because you want to make sure that at the end of 3 years you have the money to put a down payment on the house. You don't have time to ride out the short-term volatility. So that's a easy way to think about which risk level might make sense for you. And so it doesn't mean the same thing. The 36% does not mean the same thing as the 6.5 because the 36% is typically we recommend it for really long-term investment timelines and only if you have the risk appetite for it. And then the 6.5, it's kind of more for kind of your short to medium term investment needs.
Gotcha. Okay. Let's see. Last question. What is your take on endowment regular savings plan? Do they have a place in our portfolio if we're looking to diversify?
I'm guessing the endowment regular savings plan here is referring to an insurance plan, endowment plan with an insurance company. In my opinion, I do think we try, and I would encourage you to think about insurance and expenses separately, just because the fees for an endowment insurance plan can get quite exorbitant. There are a lot of lock-ins, so obviously that's something that lock-in is an inflexibility and it's a cost to you, right? So insurance in general, I think, should be thought of as an expense. It is a necessary financial plan B to have. And then your investments should be thought about separately as well. So that's what I would encourage. And is there anything we should look out for? Fees. I think one thing you realize with these endowment plans is that they're very, very high in fees. So make sure you ask your financial advisor, what are the entry fees, what are the regular fees, and any fees if you decide to withdraw.
Yeah, I agree with you. I think the fees, a lot of them are hidden and
Yes.
they definitely like your money will snowball. And then when you decide you want to get a payout and you realize where's a portion of my money? It's like, oh, it went to fees. So yeah, I learned the hard way. Okay. Yeah. Actually have one more question. So what is a piece of advice you would want to share with someone who's just getting started on his or her investment journey?
Yeah, so I think the one thing is to just make sure you build a diversified portfolio, right? I wouldn't recommend starting your investment journey investing in one stock, right? Because if something happens, kind of maybe something happens tomorrow that is adverse for the company, there goes your entire kind of investment portfolio. So build a well-diversified portfolio. Use maybe ETFs, exchange traded funds, where typically the fees are low. One ETF itself is very well diversified. So make sure you build a diversified portfolio, and make sure you keep in mind the fees you're paying for any of these investment products.
Gotcha. Okay. I think I'm going to just wrap up this with one last question. And I think it's a huge topic because everyone keeps talking about it with like the ups and downs regarding Bitcoin. So yeah, just like, what are your general thoughts on it? And what do you kind of think of like what's going on right now?
That's a funny question because we talk about Bitcoin every single day.
Oh, good.
So for me personally, I'm not invested in Bitcoin. Obviously, Bitcoin has gone up a lot over the past 2 or 3 years. I was very much a skeptic, I would say, a few years ago, and obviously, I did not think it would reach current levels. But it shouldn't. It obviously is not really. I wouldn't really consider it an asset class, right? So it's not something that we really know with time how it's going to perform. Unlike something like long-term bonds or short-term bonds, for example. And so in general, I wouldn't recommend just investing in Bitcoin, right? All of your life savings should not be put into Bitcoin because, as you can see, it's highly, highly volatile. It's not something you want to put your life savings on. If you're interested in Bitcoin, maybe a small allocation to it in your portfolio can make sense. So maybe I would recommend maybe the max 5 to 10%, nothing more than that. Because it's definitely something that you can have, but you don't want to bet your entire life savings on that on a very volatile security like Bitcoin.
Yeah. Oh, thank you for your insight. Yeah, I was just curious to know what your thoughts are on it. Yeah, it's very, very much a hot topic right now.
Yeah, absolutely. It's something that I think a lot of people I see on the news every single day. Oh, Bitcoin is reaching new levels, and then Bitcoin fell again. So it's a new thing every day with Bitcoin.
Yeah, awesome. Well, yeah, I mean, I think those are all the questions we have for today. Thank you so much, Amanda, for doing this entire webinar for us and answering all of our questions. Really appreciate it.
Thank you so much again for inviting us on, and we hope to do one again with you guys soon.
Yeah, sounds
Thank
good.
you, Emily.
Thank you. Thank you, everyone. All right.